By now you've likely seen the headlines. The United States and Israel have launched military strikes against Iran, targeting its leadership, military assets, and nuclear infrastructure. Iran's supreme leader has been confirmed killed, and Iran has responded with missile strikes and drone attacks across the Middle East. This situation is still developing, and our first concern, as always, is the safety of civilians in the region and our American servicemen and women. But it's completely natural to wonder, what does this mean for markets and what does it mean for my portfolio? So today, Greg, Paul, and I want to walk you through a few key things to keep in mind as these events continue to unfold. The short answer is this: history shows that those who stay disciplined and in control of their emotions tend to come out ahead. So let's explain why. As Eisenhower once said, and this is relevant to today, plans are worthless, but planning is everything. So we can't predict specific events, but we can build portfolios designed to withstand exactly this kind of uncertainty. To understand what's happening right now, it helps to zoom out to start. And so Greg is going to share with us some context on how we got exactly where we are.
Let's talk about context. Strikes you're seeing today are the latest chapter in the story that's really been building for years. Iran and the West have had deep tensions for decades, which is probably not a surprise. It is rooted in Iran's support for terrorist groups like Hezbollah and Hamas, its nuclear ambitions, and its role in regional conflicts. So here are a few key moments that set the stage for where we are now. In 2019, Iran launched drone strikes on Saudi oil infrastructure and temporarily rattled global energy markets. If this strikes a distant memory, it's okay. It was pre-COVID and feels like a really long time ago, but it really wasn't. In October of 2023, Hamas attacked Israel, which drew in Hezbollah and significantly escalated Iran's involvement in the region. And last summer, Israel conducted a direct 12-day military campaign targeting Iran's nuclear and ballistics missile programs. It was the most significant direct confrontation between the two countries in a really long time. Earlier this year, Iranian protesters challenged the regime, with President Trump pledging U.S. support. Negotiations over Iran's nuclear program was broken down, and in the weeks before the current strikes, a significant U.S. military buildup in the region made clear that something larger was being planned. So what we're seeing now, including the targeting of Iran's senior leadership, is really broader in scope than anything we've seen before. But history also shows us that even major geopolitical shocks don't always translate into sustained market disruption.
And that context is really important to understanding where we are today. So thanks, Greg, for sharing some of that information. Now, one of the most important related market questions that we're hearing a lot about is energy related, especially given where Iran sits geographically. Paul is going to take us through what's happening with oil prices in the Strait of Hormuz.
Energy is the most direct link between Middle East instability and the financial markets. Iran has produced, or does produce, 3 million barrels of oil per day and sits right on the Strait of Hormuz, the world's single most critical energy waterway. And so according to the U.S. Energy Information Administration, it's roughly about a third of all seaborne oil and exports, and about a fifth of global natural gas pass through that strait. And so any real or even just perceived threats to that corridor can really move markets. So oil prices, they've already been climbing in anticipation of these strikes. And the immediate reaction, it's pushed WTI crude into the low 70s and Brent to just under $80 a barrel. I can see how that could sound alarming, but let's put it in perspective and let's go back in 2022 when Russia invaded Ukraine. Oil peaked at nearly $128 a barrel. And so we're nowhere near that, and there's another key difference today. The United States became the world's largest oil and gas producer back in 2018. So now outpacing both Saudi Arabia and Russia, that domestic production provides a meaningful cushion against any foreign supply disruptions. So it simply didn't exist in decades past. So it's also worth remembering how hard oil prices are to predict. And when Russia invaded Ukraine, many expected high prices to persist for years, but instead they stabilized pretty quickly. And the same thing happened earlier this year when the U.S. conducted operations in Venezuela. There was a brief spike, and then markets moved on. So the situation is fluid. Prices could move further, but history suggests that markets initial reaction is often the sharpest.
All right, thank you guys. This is exactly the kind of context that really matters when headlines are moving fast. And so here's what we want you to take away from this. Iran has been sanctioned heavily for years. Its currency has collapsed. The direct exposure that most investors actually have to Iranian economy is essentially zero. It's not a lot of representation in any of the mutual funds and ETFs that you might own. Markets have been finicky with what's been going on and what we've seen trends, and we expect that this volatility might persist in the days and the weeks ahead. Oil prices could continue to climb further, and sentiment might be shaky, and it's okay to feel that. It's okay to recognize that the emotional strain is there, and that's normal in situations like this. But as advisors and practitioners, we see that it's investors who historically come out ahead are going to be the ones who can put their emotions aside and think logically and rationally and stay diversified and resist the temptation to make big moves based on short-term headlines or short-term emotions. Let's take a quick note on diversification. It's commonly thought of as having your personal mix of stocks and bonds. So you think of like traditional 60-40 stock bond split portfolio. So the type of asset, a stock or a bond, is certainly important when it comes to being diversified. But so is how what you own is represented in an index and how you determine what to buy, whether it's technically or fundamentally motivated, and also how long you intend to own it for. So diversification is about much more than a mixture of stocks and bonds and what it does to help out to smooth that ride. So it's things like what you own, your time frame, your time horizon, and how you structure about moving them around based on what's going on. Diversification is important because we see that even missing a handful of the very best days of the market, which typically happens right in the middle of turbulent periods, it can often meaningfully reduce your overall long-term returns. And so the saying that we have is volatility clusters, which means that if you see a really bad day and you're like, oh my gosh, and you wake up and it's, you're feeling that emotion, it's good to remember that typically those really bad days are also found around the time periods of really good days. So if you happen to experience that bad day, you want to stick around for the good days. And so the bottom line is these are serious events and they deserve serious attention. But don't change your financial plan because of what's going on today in Iran. We don't know what's going to happen tomorrow. And so this shouldn't change your portfolio. If you have questions about how this affects your personal situation, your portfolio, or what diversification means for you, please reach out to us directly. That's what we're here for.